The number everyone is chasing, 67,000, could be the biggest trap of the year. While the AI gold rush narrative is blindly buying Nikkei futures, a hidden sell signal is flashing on multiple timeframes right now. At 60,815, the index is sitting on a pivot that could unleash a 2000-point drop before that AI dream ever materializes. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use immediately. Instant market verdict. Session bias, sell the rallies. The 5-hour trend is a solid sell, and the daily chart is stuck in neutral but bleeding momentum. This is not a time to chase the AI narrative. It's a fading opportunity. Write this number down. 61,595. If the Nikkei manages to close a 4-hour candle above 61,595, the whole bearish structure shifts and we pivot to a breakout chase. Until then, the path of least resistance is down, and I'm positioning for lower prices. Let's walk the charts from top to bottom so you see exactly why the bears are taking control. On the weekly time frame, the Nikkei remains in a larger uptrend, but it's stalling right at a rising trendline that's been in play since the start of the year. This week's candle is already printing a bearish engulfing shape, and the weekly MACD histogram is rolling over from extreme highs. That is classic exhaustion. Most traders miss this because they're staring at the AI headlines. Here's what they miss. On the daily chart, price has broken below the 20-day moving average, which is sitting right around 61,200, and it's now testing the 60-day moving average at 60,950. Both averages are flattening and beginning to curl lower. The 200-day moving average is down at 59,800, acting like a magnetic target. Every time the Nikkei loses the 20-day and 60-day cluster, the 200-day gets tested within days. The daily MACD is showing a clear bearish divergence. Price made a marginal high near 62,000 2 weeks ago, but the MACD line printed a lower high. Buyers are exhausted. On the 4-hour chart, the story gets uglier for bulls. We have a sequence of lower highs, a death cross of the 20-period and 60-period Mars, and the MACD is buried below the zero line. The 4-hour is telling you the selling pressure is real. Zoom into the 60-minute chart and you'll see price is struggling to stay above 60,800, with a series of wicks rejecting any push towards 61,100. The key resistance zone I have is 61,544 to 61,595. That's where sellers are reloading. It's a supply block formed from previous support that got broken, and it now acts as a ceiling. On the support side, the immediate floor is 60,500, but the real magnet is the 200-day moving average at 59,800. Below that, 59,200 becomes the next structural support. And I need you to see the cross-asset validation here because it's the knockout confirmation. Look at US dollar to Japanese yen. The pair is teetering at 145.50, the yen is strengthening, and every tick lower in dollar. Yen corresponds to a tick lower in the Nikkei. They are moving in lockstep. The ghost of BOJ intervention is back. If US dollar to Japanese yen breaks below 145, it will likely trigger a cascade stop run in yen crosses and a violent Nikkei sell-off. The risk sentiment is aligned. S&P 500 futures are rolling over from their overnight highs, and the VIX is perking up. This is not just a local Japanese story, it's a global risk-off pulse that is starting to hammer equity indices. The Nikkei is the most sensitive to yen moves, and that makes it the front line. Now, what's the fundamental fracture here? The 24-hour news cycle is screaming about Japan's AI gold rush, with analysts throwing out 67,000 targets based on semiconductor export growth and massive capex. That narrative is real, but it's already priced in over the last 3 months. What's not priced in is the sell-off that looms when the BOJ opens its mouth. Yesterday, a BOJ board member hinted that if inflation stays sticky through the summer, a policy tweak is on the table. That sent the yen soaring in the crosses and instantly knocked 300 points off the Nikkei. The AI dream relies on a weak yen to fuel exporter profits. A hawkish BOJ kills that thesis. And the positioning data shows that retail and foreign speculators are heavily long Nikkei futures at these elevated levels. When everyone is on one side of the boat, the water gets rough. The intervention fear is not a joke. The Ministry of Finance has a history of stepping in when the yen moves too fast, and that kind of shock will send the Nikkei into a free fall. So the 1 to 2 week directional lean is clear. I expect a retracement down to the 59,800 to 59,200 region. That's a 1,000 to 1,600 point drop. The AI 67,000 thesis is not dead, but it needs a reset first. The event that invalidates this bearish lean is a daily close above 61,595, accompanied by a US dollar to Japanese yen bounce back above 147. If that happens, I'll flip long without hesitation and chase the breakout. Until then, I'm selling rallies. Most people will skip this next part, but this is where money is made. Keep watching. I'm giving you 3 trade setups, with exact triggers, stops, and reward to risk ratios, so you can act with precision. Strategy number 1, the sniper, the conservative play. This is for those who want to wait for confirmation and not leave the entry to chance. The trigger condition is a rally into the 61,544 to 61,595 zone, but only after a bearish engulfing candle closes on the 1 hour or 4 hour chart, ideally with a wick rejection and an RSI failure below 50. The exact stop loss goes at 61,750, just above the zone and the recent swing high, giving you about 150 points of room. The logic is that if price breaks above that, the structure is broken and you cut quickly. Target 1 is 60,500, roughly 1,100 points from the mid-zone entry, giving you a 1 to 7 risk reward on that partial. Target 2 is the 200-day moving average at 59,800, stretching the reward to risk to over 1 to 12. Take partial profits at T1, move stop to break even, and let the rest run. This setup is voided if the Nikkei closes a 4-hour candle above 61,595 before you're filled. In that case, stand aside. Strategy number 2, the active trader, the standard entry for those who want to catch the breakdown momentum. This one enters on a confirmed break of 60,800, but I want a 15-minute close below 60,800 with increasing volume and a MACD crossdown on that same time frame. That's the trigger. The stop loss sits at 61,200, just above the 60-day moving average and the overnight high, risking 400 points. The reasoning is that if the break fails and price reclaims that level, the momentum is false. First target is 60,200, a prior swing low where we lock in 600 points, a 1.5 to 1 risk reward. Second target is again the 200-day at 59,800. Once target 1 is hit, trail the stop to the entry price, guaranteeing a risk-free ride to target 2. If the Nikkei prints a sudden bullish engulfing on the 1 hour while you're in the trade, get out immediately. That's the tell that the trap is springing. Let's see how aligned we are. Type your Nikkei range for tomorrow in the comments now. Is it 60,500 to 61,500? Or do you see a break? I'm reading them. Strategy number 3, the aggressor, high risk, high octane. This is for traders who know how to lose small and manage risk aggressively. It's a momentum chase short right from current market price, 60,815. The entry is at market, with a tight stop at 61,100, just above the recent hourly resistance and the 60-period MA on the 60-minute chart, risking 285 points. The idea is that the short-term trend is so bearish that any bounce will be sold immediately. Target 1 is 60,350, a quick 465 points, and target 2 is 60,000 even. The risk reward on the first target is roughly 1.6 to 1, which is acceptable only if you're right more than 40% of the time. If price trades above 61,100 for more than 15 minutes, exit manually. This setup is invalidated the moment US dollar to Japanese yen spikes above 146.50. Only take this trade if you can accept a sudden stop hit and have a daily loss limit. The reward is sharp, but the trap cuts both ways. Risk management pulse, this is non-negotiable. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact Japanese economic data, especially BOJ speakers or CPI. Stops are not suggestions. They are mandatory, so here's the one level that matters for the next session, 61,595. Below that, the bearish structure remains intact and the path to 59,800 is wide open. Above that, and we start talking about the AI breakout towards 67,000, but that's not the fight today. Tomorrow, we have Japan's national CPI and a scheduled BOJ deputy governor speech, either of which could be the match that lights the yen and sends the Nikkei into the sell-off I've mapped out. If you want the full breakdown on Bitcoin and the S&P divergence, which is looking extremely fragile and could add more weight to this risk-off move, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of all 8 key assets. I'll see you in the next one, before the market moves against you.